$700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic.
Price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit, coin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar.
When we go through $50, that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to.
In today's weekly recap, 3 financial experts, Andy Schectman, Bill Holter, and Alasdair Macleod share their gold and silver price predictions, offering their perspectives on where the precious metals market could be headed next. With gold holding near record highs and silver pushing into the low $40, all 3 see major forces aligning that could drive the next leg higher. We watched hours of footage to bring you the best clips so you don't have to. Schectman warned we're in a monetary reset, with central banks quietly stockpiling gold as trust in fiat fades. He sees silver as deeply undervalued and poised for explosive gains once physical supply tightens and paper market distortions break. Holter echoed the bullish tone, saying soaring debt and deficits are pushing the system toward a breaking point. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
You're seeing the numbers in all of vaults except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But 7-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher. I mean, the old bag of tricks would be you put it into treasuries earning a fair rate of return and let the laws of compounding be your friend. Back in the day with 9% interest every 8 years, your principal would double. And, if you had 9% interest and millions of dollars, that's fine. Double every 8 years. The law of 70 seconds, 9 into 72 is 8. Problem is that where we are right now, the inflation is far higher than the rate of return. And so a real negative rate of return makes bonds a no-starter. I mean, it's a no-go. And so then what? Do you put your money into an equity market where valuations are higher than at any time, even the 1929 crash of the stock market, anytime ever, at a period of time when you have the largest ever margin debt by the retail public, the largest ever exposure to options by the public, and the largest ever participation in the stock market by the public, as the insiders are literally moving the other direction. You put it into real estate when 30 years worth of suppressed interest rates have created great distortions. And where do you put it? I guess, municipal bonds, but aren't the municipals or the municipalities in trouble too?
In today's news recap, will silver's explosive rally drive prices to $50 this month? Silver climbed within striking distance of $42 an ounce on Monday, posting its strongest rally since 2011 as a deteriorating U.S. labor market reinforced expectations of a September Fed rate cut. The highly anticipated non-farm payrolls data confirmed a sharp slowdown in job creation, with unemployment rising to the highest level since 2021. Analysts at GSC Commodity Intelligence are now pricing in near 100% odds of a 25 basis point cut on September 17th. The possibility of a shock 50 basis point jumbo rate cut has also emerged, a move that could send precious metal prices into the stratosphere. Silver has already surged plus 47% year to date, more than doubling in value over the last 3 years. The momentum is unmistakably bullish. Data tracked by GSC Commodity Intelligence shows a steady rise in speculative longs, while flows into physical silver and ETFs continue to accelerate. Wall Street desks are openly discussing the possibility of $50 an ounce by year end if institutional allocation expands further. Every indicator we track is flashing green, says GSC Commodity Intelligence. Institutional positioning, ETF inflows, and physical demand are all converging to create what we believe is the most powerful setup for silver in more than a decade. Silver is not alone. Gold has already surged plus 35% in 2025, hitting a new all-time record high of $3,646 an ounce. Analysts at Goldman Sachs now forecast a run toward $5,000 an ounce. That's a plus 40% gain from current levels. For context, 1 ounce of gold was just $35 in 1971 when Nixon closed the gold window. Today's price represents a 103-fold increase over 5 decades. The verdict from GSC Commodity Intelligence is emphatic. Those who position now will capture what could be the most profitable super cycle of our generation. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Yeah, I think your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want, they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. Seas. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they'd prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023. And you can look at a gold chart. The following day after that news came out, the price of gold started going higher. It's been like a tractor in first gear. The pullbacks, or what used to be smashes, have been very, very shallow. And here we are, we're breaking out, we're new highs on all-time highs on gold, 14, 15-year highs on silver. We're entering a new phase right now. And I think that new phase coincides with the Western bond market. Think the Western credit system is faltering. And it just makes sense. If the credit system's faltering and everything is based on credit, you want to move your assets into something that cannot bankrupt. And that's gold and silver by definition.
Well, if you don't hold gold, and I suppose also silver, I mean, there are other things. In this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, I mean, particularly food, that's going to break down. I mean, who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. I mean, that is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. I mean, think what 4 trillion marks were, if you like. I mean, it was I think, I mean, it was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions, even possibly millions. But I mean, it was a very, very low figure. So, if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. I mean, that was the lesson, really, of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for virtually everybody, because let's face it, very few people actually have gold, or have gold in any sort of meaningful way. I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives. And it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing. They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it. And this was really what I think is an extraordinary situation. Markets are focusing on the next cut in interest rates. The one thing they are completely ignoring is what the rate of inflation, CPI, call it that, is likely to be in 2026. And I can tell you, it will be soaring. It will be rising very, very rapidly. Now, the reasons for that are basically a combination of things. But rather than go into, the effect of tariffs, which, of course, the Republicans will say, well, that's proving not to be in effect. But, it takes time for these things to work through. And the weakening dollar as well, that's another factor. You've got all these factors. But when you look at the, if you like, the credit background, look at the way in which we've got inflation. We are in a huge debt cum credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down. Its purchasing power is going to go down. And if you like, the first signal we've got of that is the gold price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit. Secondly, we've got the long bond yield, which will break out above that 5.1% level, I think fairly shortly. Could be within weeks. And thirdly, we've got the extreme valuation disparity between the yield on the long bond and what's going on in equities, with the S&P hitting new highs. I mean, since that first peak, about 5.1% in the long bond, I mean, you would think, well, no, go back a little bit. When it broke out of a long-term downtrend of yields, I'm going back to, 2022, around about early 2022, when it soared through 3%. We had, at that time, I think the S&P was around about 4,200, something like that. Now it's 6,500, despite the long bond yield continuing to rise. In other words, this is a bubble. Who cares about valuations? We're going to buy because it's rising. And you got the speculation in Bitcoin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar.
What do you think of Macleod's take? Will gold continue to rise in the fourth quarter of 2025 and beyond? Are we approaching a major top in the global markets? Post in the comments section down below your honest opinion. Subscribe if you have not yet done so. And check this video right here because it's a perfect fit for you, and I'll see you on the other side. Thanks for watching.